Setting out again, why did we do that first session? I mean, I am a creative myself, don't get me wrong, right? But I want you to be in a situation when you have a creative idea and you want to have that freedom that you actually play with different angles whenever you are in a situation in front of an investor or something like that. I think the only solution how you can actually grow into that role and how you can play with that role as well, you should still be a creative, right? But you should switch, is if you have something like previously that is first for your own benefit, because then it's easier to learn. If I would just show you, like, read 5 economics books, that would probably not the right approach. So let's continue for today with that story in mind. And let's talk about different types of investments. And you have to understand that in the regards of stocks and funds essentials before we go more on the easy path. So, as I said before, this time it will be a little bit more complicated because there are more terms which you probably are not so familiar with, I assume here, but I try to make it as simple as possible, as Peter Lynch says here. The simpler it is, the better I like it. And so we will talk about simple things, investment systems, stocks, funds, and next steps for you. So let's start with the simple things. So there are basically 4 categories that we could look to. We're only looking into 2 because I think that's enough for now. So there are bonds, stocks, index funds, and derivatives. And a bond is actually that you are, as an investor, give out a loan to an entity, and you basically get an interest rate out of that, which might be owned by the government, that they give out bonds, and you borrow them money, or it might be to a corporate. Stocks, on the other hand side, truly mean that you have a significant share within the company, which is great. You have a share of a company, so you own something of that company. Index funds, on the other hand side, are basically like an investment into a so-called index. So they're replicating, like an economy might be the Standard & Poor's 500, for example, and you invest just into the top X amount of companies here. And on the other hand side, derivatives are getting a little too complicated, but easily said. You can invest, for example, into something that fails. So it is the opposite. You actually don't benefit from the success of a company. You might benefit from someone who's failing. But let's only look at the stocks and index funds. I think that's enough for now. It is important to say, I mean, I don't want to be someone with a tinfoil hat and predicting like the end of the world or something. But usually, if you just look at the numbers, the number 7 is actually magical because like every other 7th year, a crash actually happened somehow. We are right now, since 2008 was the last crash, we are already ahead of that, which is great. But on the other hand side, this is important. You don't have to be scared because I want you, if you're an investor, I want you to be as unemotional as possible. And as I said, with filling out that spreadsheet before, you fill that out and you execute on that, no matter what's happening left or right. So you are unemotional. You can be as emotional as you want in your outside investment world, which is fine, right? But within your investments, you should be unemotional and do not act on emotional happenings. You should basically look at the facts and figures driven by facts. You should actually decide on investments how much time you want to invest to actually understand everything. If you don't understand it, or if you say like, oh, it takes a year until I understand all that crap, don't do that investment. And then I want you to be actually very powerful and when it comes to the knowledge and strength, because you have to build that. It's an educational thing. And a bad system is better than no system. That's the most important one. If you don't act, if you don't start, then it's probably shit. So let's start. as I said before, diversification is important, so don't put all your eggs in one basket. And what do I mean by that in regards of stocks or index funds? You could, for example, decide in which region you want to invest, because as I said, there might be regions which are quite stable, there might be regions which are emerging. If you want to balance that, for example, you could invest a certain amount of money into the stable regions, but also in the emerging regions, because they might be more profitable even if they're more risky. On the other hand side, you might even, back to the understanding, if you actually have a strong interest into health or energy or whatever it would be, if you already have that knowledge, why shouldn't you focus on that topic? But on the other hand side, you shouldn't only focus on one topic that you know, you should diversify. So it should be one other bucket as well. It could be an industry, it could be an asset class that you define, do I invest into real estate, commodities, currencies, etc. when it comes to stocks. So investment systems, so whenever you now want to invest into a stock, let's say, you have to know how can you actually define what is good or bad. The worst thing would be you just heard an advertisement which happened around 2000 in Germany because the telecommunication company used to be government owned, and then they gave out like a stock, like here you have a share, and it was like a huge run in Germany. Everybody, every newspaper, every cab driver actually informed you, oh, you should buy that stock. That's actually always a bad sign. Like if people tell you about blockchain, for example, while I'm not, but maybe if you go to a hairdresser and they actually tell you, oh, did you invest into Bitcoin actually lately? And then it's probably a bad moment to invest into things, just saying. So how can you actually figure out what is a good and a bad investment? There are basically two different types that you should keep in mind. A fundamental analysis and a technical analysis. So a fundamental analysis is something that I personally prefer because you look actually at the data that already exists from the company. Like, for example, the annual reports could be a source, and you actually go through that data. I always do that for clients, and you should do that as well, by the way. If you actually end up on the right level, just download the annual report. Even if you don't know the numbers in there, I think it is good to know what they communicate as a vision of a company, an innovative vision most of the times, because this is what investors want to hear. You should just download that document and read it. If you don't understand 60% of it, don't care for now, but I think that is crucial within our industry to actually prepare and get to know a client if you're dealing with the right level. And that basically is that you download a document like that and you go through the data that already exists, the basis. Then you actually look at the data that was compiled over time. You compile all the annual reports, business plan, the analysis that were done by external parties. You look at the economic data, and then you can do a business valuation and ratio analysis. As I said, when you start with something, you will not understand everything, but you will understand parts, and you can decide actually, do I go that way or not? So that goes further, that you also want to know if you want to invest into a company, that you look at the global economy, maybe of a country, then the local economy close by, then the sector level, and on the other hand side, the industry level. So if you do that properly, step by step, you have a good overview on the specific company that you invest in, but also the country. And you can do that. There are tools like if you're really like an expert, I don't use them, for example. There are platforms like Simfin or Old School Value where like people do that only day to day, which they can use, and they get those data already extracted. So they don't download the information from the website, etc. They basically have tools, just that you heard that once, and they can get all the data already. So the downside with those reports is sometimes they're heavily influenced, because a bank, for example, if they did an analysis, they might have an interest on selling a specific product. So that's sometimes the thing. If you download those informations from a bank because they say, please buy this stock, then it might be a bad source of information. So you always have to look from different angles at your investments. And also the company reports themselves. I still think it's up to you to actually cross-match if it's true what they're writing in there or if it's a lot of bullshit. But even from an innovation standpoint, I tell you, download an annual report from any kind of company, bigger company, go through that, and you will already sense if it's bullshit. You will know that because you come from the creative industry, what they're telling in there, if you trust it or not. Maybe an investor who just looks at the numbers believes all the crap of flying drones who blah, 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 do the following, right? And you will say like, what the fuck? So you have an advantage in there. The other type of analysis is a technical analysis. This is usually what, for example, a trader does. So they just look at those fancy graphs, and out of those fancy graphs, they can actually tell if a stock will perform or not. So this is something that I wouldn't recommend in the beginning. Start with an annual report, download it, look at it, and look at other sources as well. Back to risk management, and we talked about that before. What's your risk level? That goes back to stocks and bonds, for example, because, as I said before, if you want to invest into something, me personally speaking, you're not a trader. It's not like in all the Hollywood or not Hollywood movies like Wall Street with Michael Douglas, where you're sitting in front of a computer and you're like, yeah, I sell and I buy. That's a trader. You're not doing that. You buy something, you hold it, and you hold it, and it's quite boring, and you hold it, and probably once at a time in life you're going to sell it, right? It's a hold and buy strategy, buy and hold strategy. Jesus. Buy and hold. So you have to have a long-term outlook, and you have to allocate your assets actually, which basically means that you have to define what you want to have as a reward and how much risk you want to take. And once a year, as I said before, I rebalance my portfolio. So whatever I plan out, in the beginning it might be only 2 types of investments. I'm thinking within a year, okay, probably for the next year, because my investment grows, I'm going to change it. And that's something rebalancing. That's if you go to a financial advisor, they tell you, hey, we rebalance your portfolio. And you will now hopefully say, yeah, okay. You will look at the portfolio after a year and you will actually decide what to change. It's nothing groundbreaking new, but if you hear it for the first time, it sounds like super awesome. So a big question is, when is the right moment actually to invest? When is it actually down or high, or do I have to invest now? Is it right now the best moment to invest into real estate, or is it a bubble already, or is it, what's the situation right now? And to be honest, I can't give you any advice there. It's like I'm not a fortune teller, actually, who can tell like, okay, now, best moment. As I said, I have some indications. If a cab driver is actually telling you on Bitcoin investments, it might be a high, a peak point already, and you sense it as well. So you have the same feeling as I have. But there is nobody who can actually tell you right now it's the best moment, and you will be a millionaire in the next half year. That's a lie. The good part is there's something called the cost average effect, and it comes back to just stupidity, I would say. So it's actually great if you just are stupid, because what you can do is, look at this. This is the price of an investment, $50 at a certain point, timing point, then 40, 30. So it's changing, right? The amount of money that you have to pay to invest into it, into a stock, let's say, is changing. But you always want to invest like $100 at the same time, maybe in the beginning of a month. And because of the price, you get different shares. So it's changing. The interesting part with the cost average effect is, by the way, that it is better to constantly, first of each month, always invest the same amount than only once, because the chance that you have the right moment for the same amount that you would spend over a year is very, very low. So usually, if you just stupidly invest the same amount at the same time every month, you end up with a higher ratio. You end up with a higher savings. That's the so-called cost average effect. I didn't invent it, obviously. So keep in mind, it's not that complicated, and it's probably, unless you want to play risky, and you say like, okay, all my bets on that one day that it will be the best point, which is most of the times not the case again. So, do you have a feel what I will talk about now with this picture? Do you know who that is? Al Capone, exactly. And yeah, so I'm going to talk about fees and taxes. Because they, by the way, jailed him because of a tax, not tax payment. Then they found a chance to actually jail him. So, as Tom Sharp says, all is fair in love, war, and tax evasion. So it's obviously not. Those are the things, like, for example, when it comes, what you can actually steer, like, for example, fees, you have to watch out, because the difference is, most of the times you make the biggest loss on investments into stocks where you actually invest. So actually the bank takes in a fee if you buy it, if you sell it, if you actually transfer it, etc. And this is basically most of the times where you lose the most money, right? As stupid as it sounds. And this could destroy your income. And same with the taxes. So you have to be smart. Like, for example, some investments, not stocks, but if you invest into gold. Gold is like a non-risky investment over time. You don't pay taxes, usually, if you don't resell within a year. And by the way, you can even, up to 10,000 bucks, you can go into any gold shop. You don't have to show an ID, usually, in most countries. And you can just take the gold out. 10,000 is not a lot. It's unfortunately very lightweight. But you can do that, and you're not paying any fees. Sure, there's a difference on the gold seller. You have to be smart where you actually buy it. But there are no other fees included, which is nice. And you don't have to pay taxes on top of that. Right. Let's look at stocks and index funds, and let me explain that a little bit further. What is actually a stock and what is an index fund, and where's the difference? So stocks, as I said, are actually a type of security that signifies ownership in a corporation. And there's a difference. There are two types of stocks, a common stock and a preferred stock. And the only difference on those two, if you read it, is with this one, you have a voting right into the company. It's when they usually meet once a year or so, shareholder meeting. And the more stocks you actually have, the higher voting right you have on decision making, right? With some preferred stock, they usually guarantee that you get a higher payback. But on the other hand side, you don't have a voting right. And that's a basic decision. And then again, you have to make to look at the key data for stock, as I said before, in analyst reports, etc., to make a decision on stocks and the market price. I didn't get paid or didn't get affiliate links or whatever by those brokers, but I can tell you these are, in my opinion, very good brokers to actually buy stocks. So usually it comes back to the fees. If you actually have a bank account, and your local bank might be a great bank, but they might charge a lot of fees, and they're very hidden. Those are actually like the cheap, like the, you probably know Aldi supermarket or something, like a cheap supermarket for buying stocks. And they have a very different business model, so they don't have all the maintenance costs, etc., as most branches of banks have. There are obviously also differences in here, and you can read about it later on. Some of them are from a legal jurisdiction in Switzerland, which is better. Some of them are in the US. But usually it's a very good marketplace, a broker to actually buy stocks, all four of them. Funds. That's something now for tomorrow that you should keep in mind, because I will talk about, as I said, wine and cannabis tomorrow. And there are two types of funds, but let's first define what a fund actually is. So usually a fund, a mutual fund, is you have like a company or a guy who collects money, and that guy, who's super smart, hopefully, invests the money into something. So he's taking care of that within a fund, a mutual fund for you. While, on the other hand side, an index fund is actually not having that smart guy, but it could be that you actually look at like the top 10, top 20, top 30, top 500 companies in the US or Germany, and they just invest into, percentage-wise, into the most successful companies. And the higher you are in the ranking in the top 500, the more percentage they invest into it. So it is rather like a, how should I say, algorithmic investment based on an index. The top 500 companies, the top 10 companies for health, the top blah, blah, blah. So this is not done usually by a human. This is done by someone. The thing is, there are, again, differences between active management of a fund and passive management. And it goes back to, this is automatically done, this is done by a human. And the perception usually is, I want to go with an expert, and you wish for an active fund that you actually have someone like Warren Buffett, you remember with a quote, owner of Berkshire Hathaway, which is one of the most successful companies in the world. Super rich, so you wish you would have someone like him. But in reality, I hope it's not disrespectful, but in reality, you get that guy who's never invested himself, is now working for a company, and if you ask him, like, how much money did you actually make yourself, and why are you actually in that position since 20 years? It's not as great. And that's a thing, that's a funny thing, that when I ask you, what is better, an active investment, a guy or girl who invests into something, or a passive investment, if I just look at the numbers, the passive investment by an algorithm outperforms the active one, right? That doesn't necessarily mean that you have like a human unicorn who outperforms like an algorithm 5,000 times, but it might be only one out of multiple thousand. Interestingly, who of you heard about an ETF? I mean, it's in the, I see at least like one hand only two hands. I mean, if you read like typical newspapers throughout the last year or two, it was like invest into an ETF, which is always hopefully not the cab driver situation. But it's a very, in my opinion, interesting way of investing because basically ETF stands for Exchange Traded Fund. It is something like a mutual fund, but that trades like a stock. So it is on the stock market and it replicates, again, an index. So it's a mixture actually. It doesn't have an investment manager. You can trade it on the stock market and resell or change and buy and hold. But it's a compilation of companies. So you can replicate a Standard & Poor index, a German DAX index. You could replicate the top pharma companies. You could replicate the top companies on virtual reality. Whatever the thing is, they actually have a bundle and you can just buy it on the stock market. And it's simple because it does the following. It diversifies already your investment. I will show you in a second, and those are the last slides, actually how you can do that, and it is more simple than I just explained. Because there are platforms where you can actually buy ETFs, like Just ETF or Robinhood, which started only with socially good investments, by the way, ETF. And Stake is an Australian one, which is interesting because it rather looks like an Amazon shopping site, but is basically investing into ETFs. So let's just look at Just ETF. And I took some screenshots actually for you. So if you want to look for an ETF, you can actually, they have a nice Etf Search button there. And you will see the following. You will actually see a criteria of the different type of investments that you want to do. Like, for example, do you want to invest an ETF into precious metals or commodities or real estate, or typical equity investments? So that basically means you have an ETF, and every stock in that ETF could be around real estate. Like, for example, there are ETFs which only invest into hospitals or elderly care centers, which is interesting because if you think about it, we're all turning older and there are more older people in most countries than younger people. It might be something interesting because real estate might rise. So you can decide with a click, okay, I want to invest into that. Then I took equity in that case. You can, again, decide there are subcategories for region, for country, for financial type, and for the equity strategy, which is it more smaller companies I'm investing in, small caps, or larger cap, etc. And after you took that decision, it will filter again, and you will, for example, this is a very simple one. It's a so-called Msci World. And that basically means, from a world perspective, they take the most successful companies as a whole, not on a specific topic, as a whole. And out of those companies, which might be, depending on the MSCI type of ETF offering, 200, 300 companies that they invest in. And all of them, the biggest chunk might be 3%, 4%, whatever the ratio would be. But you already diversified your investment. You can make sure, actually, that it's like investing in the top companies. Okay, some of them might fail, but it's out of 200 or 300. I don't care. And the price, if you buy only one ETF, is €45 in that case back then. And that's interesting because you invested into a lot of companies, and the top ones, without having every knowledge, etc. But the percentages are so small, if one of them fails, who cares? And if you scroll down, for example, just to have some examples, you get information on the fund size. So the people who actually created that ETF, how much money do they have as an investment into the fund as a security? And in that case, it is 10 million. So that's something that you should consider if it's like and they even check, like, for example, is it a good fund size? Because if it has only 200K and something happens, it might be shit. On the other hand side, you have some explanations in here, like the fees already extracted that you have to pay. The 0.2% per year that the provider takes as a fee to run that ETF. Just to give you a comparison, if you usually have that person creating a fund for you investing, they take rather like 1, 2, 3%. And that's a lot in comparison to the 0.2%. I tell you, it's a lot. What else should I point out? I don't want to go into that one. 4 is, okay. There's a difference between the distribution policy, as you can see here, because accumulating basically means that they reinvest. So everything that you earned will be reinvested, and your actually investment will grow. While I'm struggling with English word. Do I have it in here? No, it doesn't matter. If it doesn't say accumulating, that's the second one. Then it basically says that you get the dividends out. So they pay out the money that you actually made after each year. So it's not automatically reinvesting. And you can always decide in what kind of ETF you want to invest. What is interesting is here you can see even they even collect the annual report for you in English or in German in that case. And this is actually where you can, yes, this is the company who built that Msci World that I just showed you. And this is a PDF document with all the detailed information. And here you can see within that ETF, these are the kind of companies they invested in, according to the global index of the top companies. And you can see here, as you know, back at the time when I took the screenshot, was Apple, and this is why they invested 2.2%, etc. And it goes on and on and on. So they basically took top companies back at the time when they built that fund, and they're rebalancing each year and adjusting the companies which you invest in. The interesting part is, lastly, this is an Msci World. It's a worldview, and as you can imagine, within a worldview, it's very US-centric, because some or most of the largest and most successful organizations currently come out of the US. So there's still a risk in an Msci World that, for example, you invest into a lot of American companies, and if something happens there, it might be risky. This is why you usually back to your portfolio when you build it. I personally started also when I invested into ETF. It's not an advice, it was my personal thingy. 70% Msci World, and I balanced it out with 30% emerging markets because I looked at the countries on emerging markets. So if something happens here, if it's not dependent on each other, if it's another thing, you have balanced it out a little bit more. And that was a very, very easy investment with a high diversification, and I didn't want to buy each individual stock and build that. Lastly, you can even build your own ETF strategy. They have like a strategy builder, and as you can see here, this is what you're going to build, and we talked about that before. And you can say, like, I want to invest one time only, or I want to have a savings plan. Comes back to the cost average effect. If you actually did your Excel spreadsheet and you know how much you want to invest each month, you could even have a savings plan into an ETF, $100 or so, and you could invest and build your portfolio over time. Or on the other hand side, they even give recommendations. There are, that's a little more complicated, but it's, there are different strategies from like some economics gurus, like Comma, for example, and you can even just click on it, and they replicate that investment strategy. Here you can see there's a mixture of stocks and bonds, and there's a percentage of the different type of investments, like real estate 7%, 7% commodities, 30% bonds, and 56% stock. So this is the more risky part, this is the more non-risky part. And then they replicate that investment portfolio already for you. Again, I'm always critical. I mean, I like the guy who built that strategy, but when you absolutely don't know what they're doing there, then you probably, my opinion, should even start easier and not with builder and ready-made solution. If you actually think like, oh yeah, I understand what this basically means and what's a risk on that, then it's totally fine. So, last slide. And what I want you to do, that's as a follow-up again, is sketch out your first risk portfolio. I already mentioned that before. And write down your amount to invest. So this comes back to the cost average effect. How much money do you want to invest? And if you have done both of those things, like in the previous session and this one, you're already pretty damn good, right? And if you start very easy, and if you do that over time, I guarantee you the next time you're sitting in a meeting together with a client and you have some financial guy, etc., if you understand, even on your small micro level, what this is about, you are in a better position than you're currently right now. And start with your own benefit. That's everything that I'm saying here. It's for you first. You educate yourself by that, and then it helps you also in your professional life, probably in front of a client, etc. All right. I hope the second session was not too heavy for you.